Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Friday, January 27, 2017. You're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. We're going to do something just a little bit off color or different tonight. I'm going to make a prediction. We're going to have a little fun with it because what I'm going to predict, and I'm going to build a case around why, but what I'm going to predict will probably culminate by the end of next week. So we'll just see what happens. We'll monitor the situation and we'll have a little fun with it. We'll see if I'm going to be right or wrong one way or the other. So before we do that, we'll just kind of give a snapshot of what happened today, and it'll be quick because nothing happened today. So the SPDR was basically flat for the most part. We're down 38 cents, but for the most part, there was no volume out here all day long. We finished with 60 million shares, and I have to tell you that it was almost like the market wasn't even open all day long. There were some stocks moving early, but in terms of the SPDR or the S&P, there was just nothing going on all day. So it was dead out here, and there's really little change from yesterday, even though the market was down a little bit. But this is where the prediction comes in. So we're getting to the end of January. Tuesday is January 31. And Tuesday, and this isn't part of the prediction, but Tuesday should be a turning day. And whether we turn from a low or from a high, I'm not sure. But I'm going to tell you what I think, and then we'll play out a scenario. So what I think is going to happen is it's going to be a turn from a low. And I'm not suggesting a very lower low from where we are, just a low. And how low could it go? 227.50. I don't see the market getting much below that. I don't even know if we'll get to 227.50, but that would provide a pretty solid level of support even if we did. So what I'm suggesting is that the market is consolidating for one more push higher into the beginning, I believe, of February, which is really the end of next week. On the outset, maybe the beginning part of the following week. So I think this is all going to culminate in about a week. So if Tuesday proves out to be a low, this is what I think. So we've had, just look at the recent history here. Even on a small scale, you have a little tiny ABC, an A, a pullback, and a C, right? And if you take that away, I'm going to redraw that on another couple of levels here. So we had an A, a B, and that doesn't work. So let me redo that. That's not the one I had in mind. My apologies. Okay, got my faculties back. And so you have one on the bearish side where you have an A, B, C. Okay, so these play out over and over again. Sometimes our eyes need to be trained to catch them. Here's another one, A, B, down to here. Okay, and then essentially your C leg could be deemed complete once we got over the A leg, right? So it doesn't matter where the market is now. That was another pattern complete, all right? And this is just from a visual perspective. It doesn't mean anything from a technical perspective. It's more in the camp of things that are external factors that help me to determine the larger picture in kind of waves, if you will. And those of you that studied anything about Elliott waves, the market moves in waves, whether you want to say it moves in, threes and fives, or it just moves in ABC patterns, doesn't really matter. That's the way the market moves, just like the ocean moves, just like the waves in the ocean, and there's waves in the market. And so that brings us to where we are now, which is we had another low put in, and we had another push higher, so we have an A leg. And if we can culminate into a B leg down like this, okay, I think we'll see from some number, whether it's 227.50 or higher, some number in here. And then I think we'll have one more push higher to complete that C leg, okay? And what that'll do is it will bring into play, and my upside target was always 229 to 230. I've actually moved it up a little bit. I think we'll pierce through 230 a little bit. And from a mathematical perspective, this is what I came up with. So I have my own reasons why. But either way, it doesn't really matter. I think the market will likely stall out at that level. There is one higher level that has the outside possibility of happening if the market should have what's called a blow-off top. And a blow-off top could be a day or a few days where the market just runs and runs and runs, similar to, let me erase these lines, 24th and 25th of this week, okay, Tuesday and Wednesday of this week, we could have another, 2 or 3 or 4 days like that, and we could get up to a number like 235 to 236. It is possible. I have a mathematical reason why the market could actually extend to that level. It makes sense. It's possible. It's not probable. But if you see the market pushing above the levels I've cited here as the upside target, then we could actually get to 235, 236 on a blow-off top, short covering rally. Call it panic buying, call it whatever you want. That could actually happen, not probable, just possible. So what I'm mapping out here, and this is where we're going to keep track of this for the next week and see if I'm right, see if I'm wrong. Either way, if we pull back into Tuesday and into some level below where we are now, we would call that a B leg. And what we would do is look for that next leg higher to actually culminate in the first several days, first few days of February. And that could be as soon as next Friday or into the following week. But I think that's the roadmap that I've kind of built. And I have, in my view, solid reasons why that's a very, instead of probable, I don't want to use that term. I do want to say it's stronger than just a possibility. So with that, we'll move it along and we'll check out the other markets. IWM. So the IWM came down today to check out the 20-period moving average. Nothing going here. It was down more than the spider for sure, but not enough to make any meaningful difference in the market. It was a very quiet day over the entire market. IWM traded, 19 million shares against an average daily volume of just short of 31. Very light day, nothing doing. When you look at the transports down 25 points, nothing we can make of that either. It will come down, if I'm right, into Tuesday. We'll come down with the market a little bit, but not expecting a big sell-off. I'm expecting the pattern to develop across all the markets just the same. Some will go up or not go up in different magnitudes, whether it's the NASDAQ or the IWM or the transports or the Dow. They're not going to all pull back and go up the same percentage or to the same magnitude, but the chart patterns in the end will look all the same. By the way, following that, we're not, I'm not saying the market's going to crash the next day. I'm saying that's at the point in which we're going to begin looking for signs of a topping signals. Once we get that, then we'll begin to discuss what the possibilities are to the downside. I'm not looking for any, huge crash in the market. I'm looking for a more meaningful correction than we've seen in quite some time. So with that said, we are looking for a real correction, not just 1 or 2%. So we'll keep our eye on that and see what happens over the coming week, and we'll kind of check in and we'll keep score. So there was an interesting development today in the gold market. When you look at the daily chart, you can see that we came in to roughly test the 50-period moving average. I believe we didn't touch it. We made a low of 1179.70. So I don't think we didn't touch the 50-period moving average, but we were within $1. That's close enough. So we reversed, and as you can see, if I bring up the hourly chart, for example, I think it's important to take a look at it like this. Let's focus in first on the 1184 level. So we pierced through it, all right, rallied back, consolidated right below that level, and then, made our way over the next couple of hours away from that level. Okay, so they flirted with it, and my point here is that they had every opportunity to close gold below $1,184, and they didn't do it. I know I said this the other day, and we've gone lower since, but in the big scheme of things, we're really around the same level. So I'm saying that It's a bullish sign, the fact that not only did they not close below 1184 when they had the opportunity, but to rally back up and get above 1190.20, in my book, is extremely bullish in the short term at a bare minimum. So I'm looking at this as a bullish sign for the gold market. So let's go back to the daily, and what we need to see is we need to see some follow through. If Sunday night into Monday they can get the gold market running, they'll go and test 1202. They'll test the high of the next red candle, 1202.30 or higher. So that's what they'll intend to do. And then whether they fail or not, we'll see it at the time, will dictate what happens from there. But if they get going at all, that's what the gold market will want to do. It will want to go test 1200, 1202, maybe even up to 1205 or higher. And if they get, much above this candle, they'll just go step up to the next candle. And that's the way it works. The market steps up, it steps down. We go to one price level to another, each having been support or resistance at one point or another. The market tells us which price levels are important, and there are reasons why the highs and lows exist on those candles and others in the past. When you take a look at the silver market, same routine in silver, only better. We came into the 16,697 level again, pierced through the 50-period moving average, and they had a nice, healthy rally to close where? Above 17. That was always the important number, and the fact that they rallied to close above 17, in my book, is extremely bullish for silver at a bare minimum in the short run. Going over to the crude oil market. What was bullish yesterday is now neutral to not so much bullish today. We closed back below the 20-period moving average, which is slightly bearish, but not exactly a ton of bearish, because we've been trading around the 20-period moving average for several days, in fact, more than several days. So the point is that it's not as important as it would otherwise be if we had traded away from it. However, it still struggled to have any follow-through today, and so the symmetry of this pattern is essentially complete. We didn't really get above, other than a penny or so, above that high, and the market was rejected, and we're in the middle of the range again. So, who knows which way it's going to go. I'm not going to even bother taking a guess. We're just in the middle of a range, and it's very, very difficult for traders, I can tell you, to trade crude oil. Those that can trade in this environment are true professionals, or the ones making the market, because you can see all we do each and every day is go back and forth, and it's almost untradeable. There's just no direction whatsoever to this market. So we'll just leave it alone. Heading over to the bond market, 30-year U.S. Treasury bond. Got the follow through. So 149 that we identified the other day definitely was at least a short-term low, important number to the market. So that's holding. That's positive for the time being. However, in order for the bond market to stage any kind of a meaningful rally, we're going to have to get above the high from the 25th of January, 151.02 on a daily chart closing basis. Until and unless that happens, this is nothing more than a bounce. That, yes, 149 was an important number, but without a meaningful follow-through to the upside, it could easily come back down and go lower down to double bottom. Heading over to the dollar. Not real follow-through in the dollar. Tried to run up to, challenge yesterday's highs. Were rejected, and therefore nothing to really report on the dollar other than the fact that this is definitely support for the market. Anywhere around 100 or par, down to 99.60, 99.50 area that we've been talking about for a long time, was definitely support for the market. So it's not a shocker that we've bounced up for a couple of days, but again, the dollar definitely has to prove itself and rally in order to see some follow through and further upside. And with that, I'm going to wrap it here tonight. I'm David Frost. my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.